Good afternoon. It's actually Friday, December 18th.
18th. Yeah, it's the 18th.
A week from today is Christmas. And obviously Hanukkah's already started. So, we wanted to have kind of a final wrap up. This will probably be our last one of the year. This is most likely our ninth or 10th video we've done this year. Tremendous amount of material we put out this year, to say the least. Obviously in January we'll go through it all, but between the weekly commentary pieces plus individual pieces that we've actually done and pretty much 10 videos, most of them obviously, dealing with COVID. This is our last one of the year. So we wanted to kind of just give you an idea of where things stand. I mean, obviously the three-part series that we did before the election, now that the election is over, we know who the president most likely will be. And we know kind of the makeup of Congress and how that will work as well. So we want to kind of give you some snapshots, go through some situations occurring now, and talk a little bit about what's kind of going on in the average portfolio as we head towards the home stretch and the rest of 2020.
So here we are getting into it. We always want to ask, as 2020 comes to an end, how have you fared? How have you done? What's some positives that you've taken? What's something good that's actually happened for your family? And for me, I studied for a very long time for the CFP exam and sat and passed it in November. And that's been a goal of mine for 7 years. So that's really what I want to take as far as a positive. I don't know if you have anything you want to share, Dan.
Yeah, I mean, there's plenty to be thankful for. Everything, obviously with families staying healthy. Our oldest son Tyler got married in June. Such a great event. So glad that they, kept their date, and his fiance and actually now wife live in Tennessee. So rules were definitely stretched at that point. Could only have 20 people, so we flew down there, small ceremony. Like so many, they'll push their makeup date until June of 21. Hopefully they'll be able to do that at that point. But certainly happy for people staying healthy and our son's wedding this year as well.
Happy holidays and Merry Christmas. This is one thing, I think, Dan, you said you've had these client appreciation events for 30 plus years. And unfortunately, due to restrictions, we're not going to be able to have it this year.
Yeah, it's amazing. I mean, I cannot believe that we're not going to be having a client appreciation event. We did those for years, as you all know. Most of the times it was in December, revolving around the holidays, Hanukkah, or Christmas. But for the most part now, going forward, we started that a couple of years ago, moving into January, a little better time of the year, less conflicts for everybody. And now, unfortunately, with COVID, certainly we cannot get a group together like we had last January. Technically this January 2020, we had over 200 people at Christo's, and forget about it, you couldn't even have that if you wanted to. And Christo's is actually closed, not forever, but certainly they've had all their functions closed for this year as well, pushing them until 2021. So I cannot believe that we're not going to be having an actual event. But we'll come up with something in January, that's for sure. Stay tuned for that.
All right, so the Georgia runoff, which is going to be January 5th, it marks the end of the election season. So as we know right now, we don't fully have a resolved election. We think that this is really going to be split. Granted, anyone that's made a prediction about elections over the past 4 years has proven to be wrong. But even if we see a 50-50 Senate, we kind of, in the market, feels as though that you're going to have a majority and bipartisanship on both sides to get major legislation passed. Therefore, it's kind of going to create some gridlock, and the market likes that not a whole lot can be done. In fact, we'll show in some other slides that this kind of situation is actually most beneficial to the overall stock market. So this is just a quick slide touching on, this is November 3rd. You can see right at this low, we've kind of seen this spike up. And the reason for that is exactly what I just mentioned. We have a split Congress and a split White House. And so the market has responded positively to that. It's not like we saw, a giant blue wave or something like that, regardless of policies. The market likes it when policy can't impact profits. And this is also touching on that same point that in a Democratic split situation, on average since 1928, you've had the best returns in the S&P 500. So we think going forward, the market's kind of already started to price this in. We don't see a whole lot of differences as far as policy change is concerned. I mean, might they possibly look at tax reform? Yeah, but not only would you need unified Democrats, you're going to need, which would be a stretch in and of itself, both sides really would need unification and to work together on any major legislation going forward. And frankly, historically, we've shown this slide a number of times. The market doesn't really care. The market responds to profits. It responds to the major corporations. I mean, really, historically, we don't see much of a difference. And you can see the last time that we had this situation as far as the split is concerned, it was during the Clinton years, right down here. And we just had record stock market numbers. And that's because not a whole lot really got done during that time. I mean, you could consider that, politics as usual in Washington and what people really complain about. But in the case of the stock market, not a lot getting done is actually a good thing. Now, this is something we've talked a number of times about. What was unique, we'll spend a little bit of time on this slide. These are numbers that we constantly watch. These are our leading economic indicators. And some of those things are like the stock prices down here, weekly unemployment claims, building permits. And we track these leading economic indicators for a number of reasons. But the main reason is knowing the health of the economy. If you see each one of these shaded areas here, they are recessions. And leading up until every previous recession, we've seen negative leading economic indicators. That didn't happen this time. Were we on our way down? Absolutely. But you could see how just violently this spiked down in Q1 and Q2. The nice thing for us is we're starting to see some improvement in the economy with the indicators. They're not all positive yet. In fact, they're still overall negative. We are starting to see that upward trend back to a baseline of 0 at least. So that gives us some confidence going forward that 2021 is going to look, hopefully, a lot different than 2020 as far as our economic numbers. This is really important. This is something we've spoken a lot about to just about everyone that's coming in to the office. It has really been a year of feast or famine, and we're going to get kind of into the weeds with that a little bit the next few slides. If you are in these FANG stocks, that FANG stands for Facebook, Amazon, Apple, Microsoft, and Google. That makes up a full 22% of the profits that you're seeing from the S&P 500. That's just a huge amount from only 5 different companies. If you take all of information technology that doesn't include those, that's another 15%, but that's still tech. But you're talking about 35, almost 40% of the overall return of the market capitalization for the S&P 500 is made up from just 40% right there. So you can see that everything that was tech, whether it was, well, not everything, but the Amazons, the Amazons, the Googles of the world, they're really driving the profits because they have so much more weight in the overall index. And we've kind of seen that across the board, that there are other sectors, which we'll show, that have just gotten completely decimated, like financials and energy. That we think there might be an opportunity going forward next year to take advantage of, but we'll get into some of those changes in a few more slides. This is kind of jumps off of that same point. This chart shows if we take our top 10 stocks, which include those information technology, the Googles, the Facebooks that we talked about, they were up around 23 to 25% on the year. Where at one point, this is now evened out. This chart's maybe about a month and a half old, maybe 2 months old. But leading up until that point, everything else has just suffered. It was negative on the year. So we're really seeing a division, depending on what sector you were in this year, really determined how well you did. And even within certain categories of types of companies, you could have a growth company that did fantastically, or you could have a value company that was just absolutely murdered. So depending on where you were, really had everything to do with how your return was overall for 2020. Okay, what changes are we making? I'm sure that you've all seen a flurry of different changes over the past 6 weeks to 2 months or so. We've really spent a lot of time and a lot of time with our partners deciding what changes we're going to make, what's done well, what hasn't done well, what have we gotten into, what have we gotten in out of. And it really falls into a number of key things. One, we sold out of gold. Why did we do that? We bought gold back in March, not because of COVID, but because we've been planning for the better part of the past 2 years to go into a recession. And during times of extreme volatility, gold typically does well. It did well back in 2008. It did really well for us this year. We ended up selling out and making around a 20% profit on that from the time that we bought it in March, which is great. It served its purpose. And we feel as though going forward with the vaccine on the horizon, there's going to be more calmness in the markets. And so we wanted to take that money out of gold and reposition it into some other places where we see some opportunity. So where are those places of opportunity? We see it in mid cap. It hasn't recovered nearly as much, especially the value side. We see it in small cap stocks. And this kind of makes sense. If you think about the health of our overall economy, what companies got hit the hardest during the pandemic? Your mid-sized companies, your small-sized companies. What companies couldn't afford to hire people back as quick? Your mid-sized companies and your small-sized companies. They also make up a majority of the jobs in this country. So once we see those companies really pull us out and start hiring again and starting to fire on all cylinders, we think that mid cap and small cap is going to be fantastic for 2021. Tech stocks is kind of obvious. If you happen to be someone that holds a ton of Amazon or Facebook this year, you did really well. But there's other opportunities like Zoom. We do a lot of Zoom and a lot of virtual meetings. We think that this culture of working from home, it's going to evolve and change and people are going to come back to the office, but we're absolutely going to see more people and more employers giving the option to work more remotely. And lastly, we always want to be dividend growers in this situation. And the reason for that is simple, that they had the stronger balance sheets going into this mess. Therefore, they were able to weather the storm better and they were able to retain more employees. And they're going to be stronger getting out of this because their balance sheets were so strong. So this is a very busy page.
Yeah, it is. I mean, we're going to discuss a number of different areas here, but I guess the biggest takeaway from this page is just to kind of show you in certain cases, kind of what we're looking at. I mean, clearly, I think the average investor is reminded daily how the Dow is doing, how the S&P 500 is doing, but because they're obviously the most notorious indices that are watched. But for the most part, we as advisors are always going to diversify in many different categories. That means that you're going to have, if you're invested in stocks, especially if you're a little more aggressive, you're going to have money in large companies, but also you're going to have money in small companies and middle-sized companies and overseas, and so those kind of areas, will accentuate the fact that we also have a number of fixed income alternatives too, as well. So when you look at the difference between, and this chart's a little bit outdated as of October 31st, but even 6 weeks later, when you look at year-to-date returns for S&P 500, was at around 2.4% for the end of October. Meanwhile, during the same time period, small cap value category was down 18.5% still. Small cap core down 13. Mid cap value down 16. So the key is that, when you look at certain places, everything is not rosy. To Seth's point, I mean, it was really hit or miss. If you had technology, if you had companies like Amazon, you killed it this year. And because they are such good areas, if you look at global science technology year to date, 33% increase. But you look at a 10-year average for that, and it's 17.5% per year over 10 years. So to buy it now, I'm not going to say it's overvalued, but you're certainly not getting a bargain price compared to buying small cap value, buying small cap core. You not only are you looking at year to date performance in the negative, look at the 10-year average, 6.5%, 7.8%. These are areas where they have not had a very good rebound at all. Look at mid cap value. 7.5% is the 10-year average. They should be higher than the S&P, and the S&P 500 10-year average is 12.4%. So again, do we want to invest where everybody else is? S&P 500, that's an easy one, right? We could put everybody that's going to be invested in stocks into the S&P and call it a day. Or we could say, well, there's discrepancies. There's basically a big difference between some of the average diversifiers. When you look at the average 10-year returns of equities, you're looking at 9.7% is the 10-year overall average for all equities in the US. When you're buying small and mid caps at 6 and 7% on the 10-year average, we wanna buy those. We want to own those. We want to overweight them. Not to say that we think that they are going to be the best things in sliced bread and not have large caps at all, but we also think that the bargains are past us in the large cap areas. But there is some major discrepancies. Like Seth said, technology was great this year. If you own energy stocks, you're down between 25 and 30% this year. If you own, for example, healthcare stocks, down for the year, but for the most part not terrible. Financials, same thing. If you had financial stocks, banks, you name it, down 20%. So when you look at the overall market, pay attention to the fact that the average person only thinks about the S&P 500, only thinks about the Dow Jones Industrial Average, and not necessarily what other parts are doing. And there's plenty of money to invest in other places. And so the key for us is, that's a big concern for us, to make sure that we're looking at this and making sure that we're being mindful, not only on the stock side. Look at fixed income. Fixed income had a very rough year this year. We see it in some of our portfolios that invested, let's say, in tax-exempt municipal bonds. Overall, municipal bonds this year are only up 1.7% year to date as a return, versus you look at a 10-year average, and basically they're averaging around 3.25. Not bad, but again, not everything made money this year. People's natural inclination is to think that basically, since the stock market was up, that everything should be through the roof. Not really. It's really just the large part of the market was up, and everything else was just either flat or negative. So that's the key thing. It just happens to be the one thing that the press and the media focuses 99% of its effort on, which is telling you what the large part of the market's done, when there's so many more parts of the market too. So be patient. When people look at their portfolios, they ask us, hey, how come my portfolio didn't rebound as much as the market's doing? I've seen you guys make a lot of changes, but I don't see that translating into my portfolio. And the reason's simple, because we're not only invested in the large part of the market. Yes, if you have 100% of your money invested in the stock market and it's just the S&P 500, you've probably done very well this year. But if you start adding in small companies and mid companies in the US, and then of course international as well, which international, other than China by itself, emerging markets only at 1.4% this entire year. So it's had a rough go. And again, Europe is even worse. Europe is in, negative territory for the entire year. And look at the 10-year average for European stock markets, only up 3.7%. All all of overseas stock investments are under 6 to 7% as a 10-year average. There's very attractive alternatives that investing in overseas make up right now. Look at the 10-year average for emerging markets, 2.4%. That's important. Why? Because we've started to nibble at that in the more aggressive portfolios because that's where the bargains are. We want to buy where the market's potentially heading and not where it's been already when we talk about large companies compared to the rest of the world.
I think I'm just to add in one last thing here. I think this number right here is very important, both domestically and abroad. This is looking at diversified. It's the entire stock market weighted appropriately. Even with the outperformance of these large companies, as of this October 31st date, we're still down around one. We're still down around two globally. I mean, and that's if you're properly diversified. I'm not sure what this number would look like if we looked at it today. I know that we've had a little bit of a rally in the past month or so, but still, you would be looking at a little bit of a rally. We'd be up a couple percent. It's not like if you're investing in the NASDAQ and you're up 25%. So, but we thought this chart was very important to try to get across because it really does show as busy as it is. Depending on where you were is really how you did. I mean, you could have hit a home run this year in lots of global sciences, or if you were in a lot of energy thinking you were being conservative, it was probably one of the worst things you could do.
And that's what we've done with cash. Cash is basically any cash we had available. We were able to obviously put into the market, but we typically have bought and tried to capitalize on the small part of the market and the mid-size and the emerging markets. The areas that represent the best discounts going forward, we really have tried to capitalize on that going forward. So we've got very little cash right now because the other thing we've done too, like Seth said before, is let's say selling out of gold. I mean, when you look at basically, gold, which is basically precious metals, you're talking about year to date having a very good return, 29%. But when you look at basically what gold has done in the last, 2 to 3 months, 3 months gold is down 10%. Perfect reason why we got out of it. Still looking at a 10-year average of -3%, but the 5-year average for gold and precious metals is 19%. So it was a perfect time for us to kind of get out while the getting was good, capitalize. We made good money in a short amount of time, and that kept the portfolio, especially in the more conservative allocated investment areas, have kept that very calm as the market was obviously being, very, very volatile between March and let's say October.
So we just want to run through real quick. As you all know, we have a number of different partners, whether it's BlackRock, John Hancock, Fidelity. We get their advice and their best ideas when developing these portfolios. And usually we have a fairly high degree of confidence when a number of them say the same things, because it really shows that they have no skin in the game. It's that they're giving us their best ideas. And that's basically every recommendation, not every recommendation, excuse me, every change that we're talking about right now, they were agreed upon by these partners. So we want to just provide a little detail here. This is from John Hancock. They're showing that we're bullish on large cap still, but also small cap going forward, mid cap as well. This is from BlackRock. This is showing that they are overweight to US, which is what we're doing. They are underweight to Europe and Japan, which is what we are doing as well. And they're overweight to emerging markets as far as their guidance going forward. So this is the Russell 1000 versus the 2000 index. We're kind of just hammering home what we went through with the big chart with this one. The Russell 1000 is your large companies. The 2000 is your smaller companies. And really, this is just showing the underperformance of the smaller companies, specifically small cap, since the recession started back in March.
And that typically does not make sense. Normally, the more risk taken, the more potential for reward as well. Small companies, in essence, should perform better than large companies because more risk is taken there. And over time, that typically does lend itself to that case. Right now we're going through a period where that's not the case. So again, a perfect spot to look in. To Seth's point before, we've got a lot of companies that we use with with the amount of money that we manage. And we use a lot of large companies. Very bullish picture for 2021. I'm not saying they all are going to be right, but it does give us a little more confidence to know that, listen, in spite of potentially another COVID pause, maybe there's shutdowns in further economies causing the market to be somewhat volatility we don't think is going to go away in the next several months. But we do know with the vaccine now on the forefront, that people will have the ability to get that and hopefully start to have a little more confidence about wading back up into the economy and starting to go through some maybe normal or I guess new normal activities.
We were just talking about small and large. This is another point on mid caps, and one of the main reasons why we bought it when we did. We started buying it, believe it or not, back in July, and we've continued that process through clearing out some of the cash. But this is looking back at the past two recessions. It's a little busy here, but basically this is the relative performance of Russell mid cap versus the S&P 500. So this shaded area here is the recession back in 2001, and this is 2008. You can see down at the bottom in the middle of the recession is right before mid cap started to outperform the S&P. Same thing happened here. We are underperforming 2007, 2008. As soon as we got our wheels going in the Great Recession, mid cap just took off relatively. This is where we are today. We still haven't seen a takeoff of mid cap. So that really gives us confidence that we're getting in at the right time as far as the middle-sized companies. And this is also basically the same idea, but with small caps. Typically, over the long term, small cap companies have outperformed the S&P 500. The zero would be that their earnings exactly the same. So if you're below this line, it means that you're underperforming. If you're above it, it means that you're outperforming. You can see even over the past 5 years, large companies have just done so well that you haven't gotten a lot of risk premium for being in mid caps because the large companies have just exploded. Historically, that's just not the case. And you can see even now how much undervalued the small cap companies are versus the S&P 500, that we believe that it's just a great opportunity to be getting in when we are. All right, where do we go from here? Expect to see some more changes in your portfolios. This is a fluid process. Dan and I speak oftenly about how we're almost happy that this recession is here. That might sound a little counterintuitive, but it's here. We prepared these portfolios to do what they did, and they accomplished the goals that we set forth for them. But we didn't know, and no one would ever know going into a recession, what sectors and what areas would be hit harder and what sectors would outperform. It's certainly been surprising for us.
Yeah, it's been very positive. I mean, you have to look beyond the fact that, yes, you have more hospitalizations, unfortunately more deaths because of COVID, and certainly most likely some more unemployment as we go into the winter months and get past the holidays. So, as it happens, you may well see some more volatility, but we think that if you can look longer term out there, that typically should get much better. Whether it's basically people being vaccinated or wanting to get vaccinated, and then basically from there just some part of herd immunity that will take over as well. That should hopefully help people start getting back out there, companies hiring people for job placement, and then obviously you and I getting back out there and going into restaurants, going on vacation plans, doing all those things. So we think that 2021 could be a very positive year, both from the economy standpoint and also from a stock market standpoint too. So we like it.
Yeah, remember, recessions are a normal part of an economic cycle. As much as it's painful to get through here, I'm sure that we all know people that have either had reduced hours or lost a job or something at that point. This is a normal part of a healthy economy going forward. You need to see it reset itself. I always talk about, when we're closing these things up, about trusting in your plan and our plan moving forward. We spend a lot of time here in the office talking strategy. Where do we want to go next? What's our active plan? We need to have this in place months in advance before we even take action on it. So this is something that you should all have confidence in, not only the financial plan that we have developed for you and your particular portfolios, but also for us and the moves that we're making in your respective portfolios.
And as usual too, I mean, you can always, call if you have any questions or concerns or want to run anything past. But, generally speaking, when we're designing these portfolios right now, hard to believe that a year ago this time, we were doing the same thing. We were basically sitting down, looking at every single portfolio and getting them ready for a recession. Certainly not a pandemic. We didn't see that coming. Nobody did. But certainly seeing, that a recession was a slight possibility in 21 in 2020, but we thought it'd be more likely in 21. And of course, COVID put us there, in 2020 instead of 2021. But we're here. We're not out of it yet. You've got to have basically, 2 quarters in a row of zero growth or positive growth. We hope that the fourth quarter of this year should be pretty good. I mean, you may not see that when you go to your local mall or anything along those lines, but online sales are so strong because people are doing more online shopping and having things delivered to their homes rather than going out and physically going to brick and mortar stores. So, we think that there's certain areas of the economy that could have some further problems, but we think, past that, could have a fourth quarter as we kind of move into the first quarter. So if you have any questions that come up at all, I mean, Seth and I are here, so is the staff as well. Mark is here as well. Mark basically does tax returns, as a lot of you do. Know that because a lot of you use Mark for tax return preparation. But we're all here, and we'll certainly have a shorter schedule next week with Christmas being next week. But for the most part, after that, we're back at regular hours as we kind of head towards the end of the year. And then come Monday, January 3rd, or 4th, I think it's the 3rd, we'll be off to the races and be ready to kind of start having reviews. It could be an exciting time to kind of, I'm sure we all want to turn the page of 2020. I can safely say that most people, that's probably the number one thing that we have heard from people is cannot wait till 2020 is over. And certainly, we feel the same way as you. Hopefully we can look forward to more and more people, getting the vaccinations, the immunizations, and making sure that they stay healthy for 21, and then hopefully allowing them to be able to go back out and start, getting back to some kind of normalcy, especially people that are sick, people that are in nursing homes that don't have the human contact right now. It really worries us. And so for their sake as well as obviously, the family's sakes as well, to be able to spend time with them, I think is huge. So from Seth and I and everybody here at Murphy Wealth Management Group, we want to, wish you a Merry Christmas and happy holidays, whatever you're celebrating. We look forward to talking to you after the first of the year, seeing and hopefully seeing you in person. But if not, we'll be doing video conferences. Certainly the office is still open, and we'll kind of see how that goes as we hopefully keep this thing under wraps going into 2021.
Yeah, I'll just extend those. It's certainly been a ride for all of us. I'm glad 2020 is over. It's been exhausting, but I think one of the number one takeaways I've taken from this is the stories that you clients are bringing into the office of, there are some positives that are going on. The people that we have that are thanking us for our work on the portfolios, to me, that's been extremely gratifying as far as the year is concerned. So I'll just finish up on my end. Thank you for your business. And if you have any questions at all, please do not hesitate to call.
Sounds great. Take care. Enjoy the holidays. Merry Christmas. And have a happy new year. Stay safe.